we've got a balance between what we really strongly feel is going to happen and what might happen. And all I'm saying is at the moment, my big strong view is in the dollar.
A group of bankers were asked to present just before the crisis to the Prime Minister, and they're saying, Russia's fine, there's no problem, we think you're in a great position. So I stood up and I told them I thought it was a very serious situation and things were really deteriorating very quickly. Kirienko, the Prime Minister, actually said to me, he said, I've read your research. He said, you seem to understand the company very well.
The gold price going up 10% in a week isn't so much a canary in a coal mine. It's a tsunami siren, and people are still going into the water to go for a swim. They're completely ignoring the risks. Gold price is telling you something bad is about to happen.
The first is that you actually put your money where your mouth is. I mean, that's unusual.
For me or for everybody?
Well, I put my hands up and DAX is down a little bit as I speak this morning.
I'm not taking any pleasure out of that at all.
Get that out of the way. Get that out of the way.
Quote unquote. We don't care about earnings.
Yeah.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 30 of The Art of Investing, brought to you by IG, the global investing platform. Now, it is the emerging market special. Yes, we're going to be talking Russia, China, Brazil. It's going to sound more like a John le Carre novel than an interview with JP Smith, which leaves me to introduce our tinker, Chris Fellingham, our tailor, Mark Holden, making me the spy and our soldier here. JP Smith, welcome to the podcast.
Thanks, it's great to be here. It's a real honour.
Can I welcome JP to the podcast? I've known JP for a long time. In fact, when I started in the city in 1984, JP was already there at Royal Insurance, where he was a graduate, as I was as well. He joined in the year before me with another guy, and then myself and another guy joined in 1984. So there were four of us, and we were good friends together. We decided, though, that we would go on holiday together. And so when I turn around here now and I look at John, it's quite triggering for me. Because I can remember going on holiday to Paros in Greece, and John didn't understand the point of suntan lotion. And we went on this beach for 3-4 days, and John turned out looking like a salmon and in agony. And all I could remember is waking up in the morning. We were sharing a room, and I wake up looking across the room to his bed, and there he was, no sleep, lying there like a salmon, pink and horrible, saying, I'm never going to come away on holiday ever again. I'm never doing any of this. And I don't think he's ever been on a summer holiday since. So that was the effect that we had on him.
The same colour as the seats behind us.
He was exactly that colour. But there's one other thing I wanted to say. There's a way back into my good books. He and I had lost touch. He'd gone his way, I'd gone my way. We were connected on, I think it's called social media, isn't it? And so we occasionally pop us, and he said, what a great podcast you guys have produced, how excellent it is. Remembering to everybody, we are still the best financial podcast of the year for another 9 months. I said you'd get sick and tired of it. But at the end of the day, he said how brilliant he thought it was. And anybody who says that gets a free invitation onto this show. So JP, welcome.
Thank you very much. There are two things actually that really struck me about the podcast. The first is that you actually put your money where your mouth is. I mean, that's unusual.
For me or for everybody?
I listen to a lot of financial podcasts, and it's quite unusual. In fact, it's the only format I can think of really that has that. And I think, Rich, that's largely down to you as well. The other thing I like about it is very educational. And I have actually, and I really shouldn't admit this after over 30 years in the city, I actually learned stuff, particularly about bonds, from listening to you guys. So anyway, that's the sort of flattering bit over with.
So we're being all very respectful.
Yeah.
Let's hope that changes for the rest of the podcast.
Can I go on to my professional introduction.
Oh, please
of
do.
JP
Yeah, sorry.
now, then.
Sorry. Yeah.
Right, let's get back to it then. He was the Chief Global Strategist at Pictet, as well as Head of Emerging Markets. You've worked for Morgan Stanley, you worked for Deutsche, but more importantly, getting into the Wall Street Journal as the one who is given the accolade of calling the Russian crisis first back in 1998. And you spent a lot of time in Moscow.
Yes.
And you were one of the top specialists in the world, weren't you?
Yeah, I suppose I was really. Yeah, I was a European fund manager and for 10 years. And then I just got very interested in developments in Russia. And I went over there. I worked for a Russian brokerage. And then I was the Russian strategist at Morgan Stanley. I went round, and we can probably talk about this later, visited a lot of companies and realized that the Russian economy hadn't stabilized and that there was a risk of something very unpleasant happening on a macroeconomic level. And I guess that call, if whatever reputation I've had, made my reputation.
Fantastic. So we've got positions in India. We've already got a position in emerging markets. So this is going to be really interesting today. But first of all, let's find out what on earth has been going on elsewhere in the world and how did that DAX go?
Well, I put my hands up and DAX is down a little bit as I speak this morning, but I expect it to recover fully.
I'm not taking any pleasure out of that at all.
Get that out of the way. Get that out of the way. Listen, there's been so much happening this week. I could literally spend the whole podcast talking about what's been happening. But let's start with the really big thing. I think I'd call it a week of magic numbers. So as we've alluded to in the past few podcasts, we've been saying gold is very close to going through 5,000. And it did. It's up now 9 days in a row, comfortably through 5,000. In fact, up 10% in the last week.
Wow.
Silver is up 20% in the last week through 100. So those are the big moves we thought would happen. We found magic numbers. Euro Stoxx 50, which is one of Europe's main indices, is down up through 6,000. The S&P 500 hit 7,000.
At last.
Half a point over it and then down it went.
Yeah, we'll go through there again.
Now
We'll go there
don't
again
be
later.
curmudgeonly over there, Rich.
I'm going to have to get my thesaurus out for that one later.
So we've had lots of big figure changes, as they say in the markets. And the one that I'm waiting for now is the Wall Street Dow Jones, which is about 2% away from 50,000. That would be a big psychological level. But lots of new all-time highs, including the FTSE. So that should be celebrated as equity risk on investors. Well, one of us around the table anyway. So
Wow.
we're
Wow.
in
I can't believe he put that in there. I really can't. There's going to be revenge for that later, I tell you.
There's been an avalanche of results this week across the world. The S&P 500 example of there's about 20% of all companies reporting this week, including the Mag 7. I'll come on to that in a minute. And at the moment, all around the world, the balance between upgrades coming through from companies against downgrades is running about 2-to-1 in favour of upgrades against downgrades. So
Less than normal, isn't it?
It's about the same. 60% is the average. So we're sort of in line with what goes on in the past. So we've had some great results from some companies out there. Europe's biggest company, ASML, had fantastic results. The analysts had expected orders of about 6 billion euros, and they came in with 13 billion euros. Now, this is the AI they make the machines that make the chips that go into AI. So their order book is enormous and accelerating still for them. Great other AI exposed companies, IBM, Texas Instruments, both shares are up over 10% in the last couple of days. And because Rich has so much coffee, Starbucks had good results. Elsewhere, we've had, it's not all been good news, of course. Whirlpool, who make your white goods, were being hit by the tariffs around the world, and they had disappointing results, as did Boeing, which, as we know, have had lots of problems with I think it's their 737 aeroplane for a long time. And Las Vegas Sands. So for those of you who go to Vegas, you're obviously not spending enough in the casinos because they had a bit of a warning yesterday. And as I alluded to earlier on, DAX has had a bit of a bad day just today as I speak, because SAP, which is their biggest company, it's about 13% of the DAX. Their shares are down about 12% today after some disappointing results.
Quote unquote, we don't care about earnings.
Yeah.
But on the other side, right, Deutsche Bank, which is their 9th biggest company, actually had very good results today. And get this, right, that this is the first time Deutsche Bank have made profits more than they made before the great financial crisis.
Yeah, having worked there, that doesn't surprise me at all.
And me too. Me too.
But one of the interesting things about the DAX spice is the way the composition's changed over the years as well. The financials automobiles and the autos used to be really big constituents, and now they barely register. So
autos are 10% now, I think. Yeah.
I think you're going to discuss this later, aren't you? So,
well, composition is interesting, isn't it? Because we obviously had Francis Donald on a couple of weeks ago, and I spotted Francis on CNBC last night as soon as the interest rate decision came out. That was the expert they went to. So big
you heard it here first, guys.
Yeah. But Francis was talking about Canada quite a lot, and you had quite an interesting stat, Canada against Brazil, just in the composition.
Yes, absolutely. So one of the big themes and things I've always looked at, because I invest in a slightly different way to you guys. My real-time returns are rarely going to be as positive, but I tend to look at it on a very long-term sort of perspective. And when I look at emerging markets, the thing I look at most of all is governance at a sovereign level policy, and also corporate governance, which over the medium long term has a huge impact on earnings. So the interesting thing about Canada against Brazil is that they have a very similar sector composition. If you look at the markets, there's materials, there's energy, there's financials, and they're really the three dominant sectors. I think Francis was saying that on a 15-year, 20-year view, Canada in US dollar terms has gone up something like 5 times, right? Whereas Brazil has gone almost exactly nowhere over that period of time. And the reason is, in my opinion anyway, is that governance in Canada, particularly on a corporate level, is so much better. Whereas in Brazil, in common with a lot of other emerging markets, the government has this tendency to intervene in the corporate sector and the broader economy. And normally that is quite bad for investment returns. And maybe that's something on the US we might come on to later.
I think we might just.
Can I just ask for a little bit of clarity for people listening? When you say governance and corporate governance, just a sentence or two about what you mean by that. When you say that word, what is it you're talking about?
Yeah. So governance at a sovereign level, I look at as the role of the state in the economy, the broader economy. So if you look at China, for example, the tendency of the government not only to own direct stakes in companies, but also to intervene in a variety of other ways. And if you look at Brazil, for example, you're looking at price controls, you're looking at dividend controls over some of the companies like Petrobras, in which they have a stake. Corporate governance is fairly self-evident, right?
Corruption, it is interesting.
Well, corruption is a different issue, and I don't look at it so much in corruption. My term is blurred boundaries between the private and state sectors. And again, in the US,
as someone who worked in Moscow would think. but
again,
on the other hand,
I point you in the direction of Washington at the moment. So.
Yeah, what I was going to say, interestingly, when you talk about governance, there you brought out taking stakes. China. Mm-hmm. You talk about price controls, Brazil, which is exactly what Donald Trump is doing as well. So we will return to this subject.
Absolutely, and we should.
Now, going back to the sort of core, we know how important the Magnificent Seven are to report. And this week, they've begun reporting. So we had Tesla last night. Their shares are up about 3%. They had good results. And Meta, who owned Facebook, most of you remember them as Facebook, were up 8%. Despite them both increasing their capital expenditure hugely, they did very well. But Microsoft also had results, and they were a bit disappointing. They were down about 4%. Tonight, we get Apple. As Rich pointed out, I think they've had about 7 or 8 weeks down in a row. So it'll be very interesting. Everyone will be looking at what their AI offering is, because those of you who use Apple, I don't mind saying myself, but Siri is absolutely atrocious. It's just awful. So they need to get that sorted. And it sounds like they might be doing some sort of deal with Google. And so people have been buying Alphabet, who's the parent company of Google. We'll see if there's some sort of get together there. But those results are Thursday night. So by the time you hear this podcast on Friday, we'll know. And we're a market mover. It should be, because Apple's still the second biggest company in the world. So, I mean, that's pretty much it in terms of the big results. We've had central bank meetings last night, which is Wednesday night this week. We had the Federal Reserve meeting. As expected, they did no change. There were 2 people who voted against that and wanted actually interest rate cuts. One of them wants to be, the next chairman of the Fed, funny enough, Chris Waller. He's about third favourite at the moment. And the new favourite is actually a guy who, used to work for a company that Chris has worked for, BlackRock, Rick Reeder, who is the head of global bonds. He's very well respected in the markets, to be fair. And so I think that would be taken quite well. And obviously equity markets would like it as well, because he leans more dovishly, as we say. So he's more likely to want to cut interest rates down rather than to put them up. And as we know, cutting interest rates is generally good for risk assets. There's 2 more big, obviously, central bank results coming up next week. We've got the Bank of England and the European European Central Bank are expected to do no changes to interest rates. So unfortunately, those of you with mortgages, you shouldn't get any relief from that, unfortunately. But in the next 6 months, we might get another cut from the Bank of England. That's what's expected. But probably the biggest central bank move was the Bank of Japan last Friday, just as the podcast came out. They did no change, which was expected. They have been guiding to the fact that there probably is going to be another 2 interest rate rises in Japan over the next sort of 6 to 12 months. And they're at 0.75% at the moment, so that would add another 0.5% to their interest rates over the next 12 months. And as we know, that has been destabilizing the Japanese bond market. So the Japanese bond market actually has improved a bit this week. So the yields have gone down, the prices have gone up. That's what we remember. After the Bank of Japan, they had a press conference. There was talk that they were going to put these interest rate rises through in the next 12 months. And the first move was actually that international investors started selling the Japanese yen because they're worried about the impact of the high new fiscal spending that's going to come through from the new prime minister that we've talked about. And the yen started falling, and that it fell quite heavily. It fell about 3%.
Just remind us, because it's such a confusing one to look at. Because when you say the Japanese yen's falling, then it actually means the number is going higher, doesn't it? Because it's the US dollar against the Japanese yen. So if you see it at 150, 160, which way is which?
They would start at 157, let's say, and they went to about 160. So the price moved. That means that you could get 160 yen for $1 against previously you could only get 157. So
the yen's weakening.
The yen was weakening. Then magically, the Bank of Japan put out a rumor, or the rumors went through the markets that them and in coordination with the US were likely to try and intervene to stop the yen weakness. They got involved. There was talk about it. Let all the brokers know, and suddenly, again, magically, the yen started strengthening. So then it fell from the 160 level, again, reverse of what you think. It fell from that 160 level and trades at about 156, 157 this morning. So that worked. And we've talked in previous podcasts about you are a fool to take on the Japanese when it comes to their yen, because they when they draw a line in the sand, they stick to it and they are able to control it. And they'd have a very good record at intervening in their bond markets and controlling yields for a long period of time. And the Japanese bond markets, the yields improved again. So the yields went down, the prices went up, and that helped stabilize global bond markets around the world this week as well.
The yen changes, the carry trade that we've talked about a lot. We've obviously got 10% holding of Japan in the portfolio. What do you think the way that situation's unfolding?
Normally, when the yen strengthens, i.e. it goes down in Mark's parlance, as he was just talking there, it's normally associated with a time of stress in the financial system. And many people who worry that the markets are topping out will go long of the Japanese yen because they expect the Japanese yen to strengthen. So at the end of the day, I think if we were to see it strengthening considerably from here, that would make us more nervous about what was going to happen to markets in the short term. Me personally, I don't actually think that's going to happen. I think that the yen is moving around. Scott Bessent came out and said they hadn't been doing anything, and the yen weakened back up again to 157, as Spice was saying. It's undoubtedly the Japanese have identified a level, let's call it 160, and they don't really want the yen to weaken past 160. So my suspicion is they're just trying to keep people on their toes, stop the positioning of the market getting too one way, and therefore they'll be reasonably happy with what's happened so far. Another one to watch, as we've said before, the Japanese bond market's behaving itself much better now as well. Bond yields got to a level where people started to buy it. They felt it is sold off enough. And so at the moment, everything in bond land is pretty safe. I suppose the only bond market that hasn't done so well has been the UK, which is sold off a bit. It did really well in the first few weeks of January, and it's come off in the last few weeks, presumably to do with the political situation with Andy Burnham, Keir Starmer, etc., etc., etc. But actually, in the bigger scheme of things, they're not really moving.
Right, moving on. We're on to the portfolio, and it's been a really interesting week. So, as always, the BlackRock World Mining Trust tops the leaderboard, up 4.5% on the week. A magnificent 77% return since inception. That tells you what the theme of the week has been yet again. The S&P, because it's GBP hedged, thanks to Mr. CJ Fellingham over here, has given us a return of 1.7% against the NASDAQ, which is in dollars, of only 0.4%. Then on the downside, I'll tell you what, I'll pass it over to JP. What's India done on the week there at the bottom of the leaderboard?
India's slightly puzzling. I mean, admittedly, it is probably the most or second most expensive market in the world. You have seen some big foreign selling out of there. The general feeling is that basically the fundamentals are okay. Growth slowed a bit, I think about 6.5% now annualized. And the central bank, the Reserve Bank of India, I think, has intervened to support the currency a little bit. But the feeling is the fundamentals are okay. I think India is basically suffering from a bad bout of indigestion. There was a lot of retail buying.
Delhi Belly, I think it's called.
Yes. But the foreign, and there's what I term the India-China displacement trade from foreign investors. So when China is doing well and people want to put money in China, as they have done over the past 15 months or so, you remember 18 months ago, everybody was saying China's uninvestable. Now you've seen a lot of foreign flows into that market. Quite a lot of that money has come out of India. Hasn't come out of the other two big Asian markets, Korea and Taiwan, because of what's happening in tech and AI. And maybe we'll talk about that later. So, it's basically the lowest beta, I think, of all the big emerging markets at the moment. I'm not sure what I'd do with it. I think if you're generally cautious about markets, I'd probably hang on to it. If, on the other hand, you've still got plenty of good places to put money, then you might redeploy it.
Well, I think that probably leads us on to a question we like to ask every guest, is looking at that portfolio there, what would you do? What would be your critique of it?
In a way, you don't want to ask me, because I'm sort of not as much of a real-time investor as you guys. I mean, I think we are in the later stages. Bubble is a horribly overused word, but to me, most markets look very expensive, and I have probably got of my own exposure, probably about 30 to 35% in equity. About half of that is still US index funds, which I bought in 2009, 2010, and which I've been selling off really since basically over the last 5 or so years. I have actually, partly on the back of your podcast, put some money into the 250 recently, so I don't think that looks terrible. The FTSE 250. But I have to say, I'm done something which is very contrarian, very unfashionable. I've got quite a lot of money in UK gilts. The furthest out I've gone is 10 years, and my average duration's probably about 4 years. And at the moment, I'm happy to sit on that, because I think you will get, at some point, a good opportunity to put money into equity markets at levels generally that are much better than now. And I also have a reasonable position in Japan, but I'm questioning that a little bit now. It's done very well. And obviously, if the yen were to strengthen, then the relationship with the equity market is a little ambivalent. You've got a lot of overseas earners there. So
just you've mentioned a couple of things that we do hold there. So the FTSE 250, a good week, up 1.5%. The Nikkei has bounced back, so up 1.4% on the week. And then emerging market ETF that we've got itself up 1.2%. So those have helped us this week to an overall gain of 0.9%, which gives us a total return since inception, Spice.
16.5%. Well, 16.4%.
Well done, Spice.
16.4%.
Can I just say one thing? I didn't quite recognise our portfolio table, because Van Eck wasn't at the top or bottom.
Oh, yeah, true.
Now, this is a period of stability for Van Eck. I mean, for heaven's sake, it's normally right up there or right down there. And here we are, actually pretty unchanged. So that's a victory for lack of volatility.
Talk about tempting fate.
Bitcoin was up 1.9% over the week, so that probably explains it.
And down 1.9% today.
Yes, it's all over the place.
Okay, so emerging markets, 5% of our portfolio. We've got India, also 5% of the portfolio. So that was the original idea for getting an EM expert in. However, firstly, I want to hear about some of your experiences in Russia, because I was head of emerging markets for Credit Suisse, went to Moscow a few times, had, an incredible time there.
Yeah.
But I certainly wasn't there at the fall of communism and the way that the Russian market came back into the ownership and the oligarchs were made.
Yeah.
But you were there on the ground experiencing all that, weren't you?
Yeah, I mean, I only went there full time, so to speak, in 1995. But my first visit was 1991, and it was actually the month, November, December, when the Soviet Union was splitting up. And it was incredible. It was I was a European investment manager. I went with a few other investment managers on this visit. We went to Moscow, Petersburg, Nizhny Novgorod, which is about 500 kilometers east of Moscow. And you could sense the chaos. And for me, there was a light bulb moment. We went into the former Soviet Central Post Office, and it was a big building. It had a gallery around it, and it had a big floor, which had previously been occupied by the post office. Obviously had the busts of the heroic workers, the Order of Lenin, all the rest of it. But downstairs, what was going on, and by the way, it's a time when there was hardly any food in the shops. There was nothing, right? It looked a pretty desperate situation. And you look down and there was this commodity exchange. And when I say commodity exchange, there was a ticker, there were traders, there was a well-stocked bar and restaurant. And I asked the interpreter, I said, what are people trading? And I thought, well, it would be stocks or something like that, which didn't make a lot of sense. The answer is they were trading anything. There would be like Kamaz lorries or sort of container loads of condoms from Malaysia or food and it was a kind of, so this is how the transition takes place from a command economy to a market economy. It's messy, it's unequal, but there was something just very compelling about it. So I went off, I started to learn Russian. I did a postgrad course in basically the economics of transition. My tutor was Jacek Rostovsky, who'd been one of the three people who had essentially helped to transition Poland, which was much earlier in the cycle than Russia, from being a communist economy to being a market economy. And obviously Poland's been very successful. He subsequently became the finance minister. So that was my sort of awakening, if you like, into Russia. Over the subsequent 3 years, you then had the voucher privatization, which now has got a very bad reputation in retrospect, but at the time seemed to most people, and Credit Suisse were obviously instrumental in this, maybe a bit before your time, Rich, but the idea was that you would create new owners. So they gave vouchers to every member of the Russian population. Essentially, these vouchers were then brought up partly by company insiders with one or two outsiders who then consolidated them. And that essentially meant that the control of the companies passed into the hands of a relatively small number of people. And that was exacerbated by something called the Loans for Shares scheme, where 4 or 5 oligarchs essentially got control before Yeltsin's re-election in 1996. In return, essentially for supporting him, they got control of some of the commanding heights of the Russian economy. Not Gazprom, by the way, which is obviously the behemoth and the biggest company.
But sorry,
Rich.
Literally people got bits of paper, like a voucher.
I should have brought one in with me. I didn't think, but I've got a voucher at home, a privatisation voucher.
But they hardly had any food on the table.
Exactly.
So there was an incentive to swap these vouchers.
And that's exactly what happened, food or vodka, without being flippant. And people would brokers would stand outside the factory gates, Russian brokers would stand outside the factory gates, and they would buy these vouchers from the workers.
Wow. And that's how they got the big supply of vouchers, which meant they were in charge of some of these enterprises or had a dominant view or opinion or influence on them.
And as I say, if you look back on that, it looks like it was this terrible kind of way of doing it. But at the time, speed was of the essence because people were terrified that the communists essentially would come back in. And if you remember as well, in the 1990s, the Clinton-Blair era, everybody thought that emerging markets over time, emerging economies would converge towards developed economies. So it didn't really matter who controlled the companies. It was the incentives they then had to help convert these emerging economies, such as Russia, into fully functioning market economies.
But what you then found, presumably, is the normal law of capitalism that you put all that power into people's hands, and they then do what they want and react that way, or not.
Sort of. I mean, there was an element of that, but that came later. The real problem then was that you started to have foreign money coming into the GKO market, which was obvious. It's the short term. So that was the Russian short-term bond market.
Thank you.
So you had a growing budget deficit. If you think about it, under a completely state-controlled economy, everything is fiscal, everything is state-controlled. Yeah, sure, there'll be a few cooperatives and so on. But essentially, you have this massive state sector that dominates the economy. And then there are vestiges of that stretch into every aspect of life. So in Poland, Hungary, and what was Czechoslovakia, now obviously the Czech Republic, the process of conversion wasn't straightforward, but Russia was just much, much more complex because communism had been there longer. You had production lines that were scattered across all sorts of countries in the former Soviet Union. So it was much, much more difficult process to happen. And this foreign money was coming into both the bond market and then the equity market. So these companies that have been bought and consolidated through vouchers then became, a lot of them, tradable shares. And you started to have relatively significant amounts of foreign money coming into the market. And the problem is that the Russian economy hadn't really stabilized. Now, you couldn't see that if you were sitting in Moscow or London and you were looking at the macroeconomic data. So I'll give you two examples of books by very good economists that were published in 1996, 1997, which essentially expressed the conventional wisdom. One was Anders Aslund, who's a brilliant economist, and he's doing fantastic work in the Ukraine, but he wrote a somewhat premature book called How Russia Became a Market Economy. In other words, people thought it already happened. The other was Professor Richard Layard, very eminent professor. I went to a seminar actually at the Foreign Office where he presented this book to a number of the sort of great and the good, so to speak, and that was called The Coming Russian Economic Boom. And so, and
this was in
1996, 1997.
That hasn't travelled well.
And so how, and by the way, so I started going slightly wary on Russia at the start of 97. I should tell you the stock market then doubled, right? So any other firm would have fired me. And I was very lucky at Morgan Stanley because it was run by investment bankers rather than traders. And they were more interested in knowing what would happen over the medium and long term. They genuinely had a strategic perspective. And the reason I thought the Russian economy was in trouble, because I went out and I visited companies outside Moscow, and you could see, it was obvious, right? In retrospect, crises are always obvious, but they weren't being paid for most of the goods they produced, or if they were being paid, a lot of them, they were being paid in barter. In other words, like agricultural goods from the Ukraine or whatever it happened to be. And the Western accountants, because some of these companies actually started to present Western accounts, they actually essentially underwrote or vouched for, endorsed the barter sales as though they're equivalent to cash, which obviously they weren't.
So you were legendary with your timing.
As always, Chris.
Yeah. But the investment bankers took the longer term view.
Yes.
And essentially that made them, or gave them, protected them from then what went wrong. Because you were absolutely right in your thoughts.
Well, it wasn't just me. I say I was very impressed by the way that the firm sort of coordinated the whole activity in Russia. I mean, we had a couple of brilliant guys who ran the Moscow office, Andrew Balgani and Raya Simonyan. Raya used to run Rosneft, the Russian oil company, and he knew everybody. So we would literally go in, to what was the Politburo. I remember once, this is very self-serving and name-dropping, so I apologize, but a group of bankers were asked to present just before the crisis to the Prime Minister Kirienko and the Finance Minister Zadornov. And being fairly reticent, the other bankers grabbed the front seats and Raya and I are at the back. And they're saying, Russia's fine, there's no problem, we think you're in a great position. And Raya sort of nudged me and he said, right, stand up, JP, tell them. So I stood up and I told them I thought it was a very serious situation and things were really deteriorating very quickly. And Kirienko, the Prime Minister, actually said to me, he said, yes, he said, I've read your research. He said, you seem to understand the company very well. But and I'm not saying that so much for me, but that was an endorsement of the way that Morgan Stanley operated in Russia.
We're allowed to say it's an endorsement of
your
research as well.
Of you. I think that's fantastic. I just don't know why you weren't buying all these vouchers and becoming a real capitalist on it.
Can I tell you?
You could have owned a football club by now.
I'm going to ignore that comment. Can I tell you maybe about one of the visits that I made that might illustrate how bad the situation was?
Yeah, please. Come on.
So this was in 1997. It was a company called Rostelmash, which is located in Taganrog, which I think was the birthplace of Chekhov. Anyway, it was about a 2-hour car journey, the most terrifying car journey of my life, but that's another story, from Rostov Airport. So Rostov is a big port near Chechnya, near the Caucasus. And we went to see, myself and Andrei Rudenko, who is my analyst, because I had a team of great analysts working in Moscow as well. We went to see the management at the company. They made, I think it was about 1 million tractors in 1984, right? And the number had gone down a bit by the end of the communist period. In 1997, they produced 2,000. So, and the workforce had been reduced. It had been reduced, I think, from about 50,000 to about 25,000. But, the lights were still on. They were still producing stuff. Essentially, somebody, and the workers, of course, payments were delayed as well. They had about 65% from memory non-payments or barter payments. And that was for a tiny number of tractors anyway. So somebody was subsidizing that. Now, who was subsidizing it? Well, it was the companies that over the long term proved the most viable, namely Gazprom, which supplied a lot of the tax revenues, and also to an extent the oil companies as well, less with the oils, but certainly with Gazprom. And of course, what that meant, if you aggregate that writ large over Russian manufacturing industry, in the end, the government was bound to run out of money. And unfortunately, that's what happened. And they had a devaluation and a default.
And the rest is history.
Exactly.
And so, let's bring it to the portfolio as such. We've got a position in the emerging markets. Do you like that position? Would you, given your view of where the world is at the moment, think that that's a good position to have? Would you add to it? Do you think that there's still returns to have? Because clearly they've done pretty well over the last 6-9 months, but they had done pretty badly for the previous 10 years.
Yes, that's essential context, actually, Chris, because from 2010 to 2024, emerging markets only outperformed the S&P in 1 year, which was 2017. They were massive underperformers. Sorry, I interrupt.
No, that's fine. I want your view. You are the expert. We are playing at being experts, but we don't have your background in it. So what I'm really saying is there still opportunity there? Should we be looking to add? What are the things that really drive that emerging market index to do well?
So if you look at, and so I should say, by the way, I've been way too pessimistic on emerging markets over the last year. I mean, last year in 2025, they were up about 35%, including dividends in US dollars. So a bit less, obviously, in sterling. This year, they're already up 10%. That index is already, I think, up about 10%.
Very strong last few days.
As from last night. But that is largely driven, not solely, but largely driven by the North Asian markets. I mean, TSMC, again, Spice alluded to
TSMC being?
TSMC being the
Taiwan Semiconductor
company. I think that's about 12% of the entire index now. Korea is another big constituent, and the stocks that have been making the running there are Samsung, which is another chip company. That's like different chip company, obviously, and SK Hynix as well. And these are really key constituents. So I would almost throw the question back at you. I mean, the fact is you would have done far better at investing in emerging over the past sort of 13, 14 months than I would have done. The one where I think you maybe, leaving aside the AI cycle and tech cycle, the one where you should, I think, be a little bit more cautious now is China, which is the single biggest index constituent. That has been going up probably because the economy has been so poor. And I know that sounds perverse, and to a lot of people listening to this podcast, they'll be going, what's this guy Smith going on about? Sometimes in markets, when
it's not just people listening to the podcast.
Exactly.
Right, sorry, that's a yellow card to Fellingham.
Well, because I made him hesitate.
No, it's a fair. So sometimes, obviously, when economies are weak, it leaves more money available for investment in financial markets because there's less capital investment. Now, actually, in China, you have both, and you've also had a big property bust as well. But the government, partly because of the property bust, and also because there are other reasons, particularly overcapacity, why Chinese industry has been struggling domestically a little bit, have been quite anxious to push the domestic and indeed the Hong Kong offshore, because there are two main bits of the Chinese market. There's the Hong Kong listed stocks And then there's the sort of A-share universe as well. So Beijing has the national team, which essentially are state-affiliated institutions that will buy the market. And also they use what I would term moral suasion to persuade, in inverted commas, the population to buy it as well. Now, they have been reining back on that recently. So then they're very cautious because in 2015, you had the market go up very sharply and then come down very quickly. And that actually caused problems in the broader economy. So again, Spice, you've talked about the emerging market ex-China ETF, which you could buy. So that's one option. Personally, because I'm relatively cautious on tech, CapEx, AI, and all these other things, I would be inclined to look at emerging market debt, where I have been a little bit more positive. But I know, Chris, you have quite a strong view on the dollar as well. And certainly if you were to be very bearish on the dollar, then actually most of the things that I've mentioned wouldn't matter and the index would probably just go up quite a lot more.
Dare we get into this, Spice?
Well, I think before we do that, sometimes people say on this podcast that I'm unfair on Spice.
Chairman, right? Never.
But Spice made a very strong call in 2015-16 when exactly that situation went on with China. Do you want to just give us that minute?
Yeah, I did a trip and I went over to Beijing, Shanghai, and saw about 30 companies. It was with Morgan Stanley, fantastic introductions to all these businesses. And not one, but every single company, as you know, JP alluded to, the state tends to own quite big shares in these companies. And often it's 30, 40% of the company.
Yeah.
And what was happening is that the government were encouraging what was called a debt for equity swap, because all these companies had massive piles of debt and the government in the background were guaranteeing this debt. So, shareholders were willing to buy it because they knew that the Chinese government would stand behind it as a sort of pay over last resort. But what was happening is that the government at the same time was encouraging the stock market to go up and telling all these companies to sell more equities, do a rights issue or issue more equity and get cash in from shareholders, external shareholders or locals or international investors, and take that cash and pay down the debt. So the government was engineering a way that the share price went up, that basically they would get cash in by issuing more shares and then they would pay down debt. And that was a debt for equity swap, you call it in the old days. But the government at the same time was saying, every time a company is going to issue more shares, this is brilliant, this is brilliant, this is brilliant, you should buy it. And the stock market was hitting an all-time high,
it went
smashing
parabolic. It was amazing.
It went absolutely through the roof.
Yeah.
I went on this trip and worked out that every single company I saw, 30 companies, one by one, were lining up to do these share issues. I went back to a very big institution Chris and I worked with at the time, and I said, this is a bubble. It's over. They are just going to issue a load of equity and try and pay down the debt. We need to get out. And it was our biggest position in our multi-asset funds. And we sold the whole lot. And within 3 months, the market was down about 30%.
So even Spicy can be bearish. I'm just saying, the bull of these podcasts can be bearish.
This is when we've really got to work.
And that's when you have to work. When Spice goes bearish, get out of everything fast.
I'd just like to mention, actually, so I'm a senior advisor at the moment at the IRF, which is the Independent Research Forum. We sell independent research, which is quite a tough gig at the moment, but we have some brilliant providers working for us. And one of them, Jonathan Anderson at Emerging Advisors, has done a lot of work on exactly that subject that you mentioned, namely dilution. And there's been a huge dilution over the past 15 years or so. So that although the Chinese economy has grown at a fair clip, actually it's not growing very fast anymore. And actually even the growth rates they say they're growing at are overstated. Earnings per share has obviously almost kind of flatlined. It's not gone up anything like in line.
So just to explain dilution to people, it's very simple, just like you're putting orange squash in. If you had 100 million shares before, they do an issue of another 20 million. So there's now 120 million shares, which basically means you have to pay the same profits out to more people.
Yeah, absolutely. No, that's exactly what's been happening. And that's one of the key reasons for the underperformance. Some people now are suggesting that process may have come to an end. I don't know. So, it's possible, even though the economy is slowed, the earnings actually might pick up. It's all perverse, as it so often is in investment. But fundamentally, I'm quite cautious about China.
I think I would like to touch more on this idea of debt getting out of control and the government controlling the population. So on to Trump and the United States.
Well, I mean, thank you there, JP, for giving us the sort of views on the emerging. Let's broaden this out to any changes we might want to make to the portfolio and where we're currently thinking about things. I have, as people on this podcast will remember, been pretty cautious on the US dollar, which is why we hold our S&P in a sterling hedged way. I'm getting really quite bearish again that we're going to have another reasonable move. Against me, I would argue that, there's a lot of people who now expect the dollar to cheapen up. So, you've got to be careful that you're not in the crowd. But I actually think that we have got significantly further to go in dollar weakness. I don't think this is a gentle trend. And let me give you some reasons why I think that, and then we can have an argument, because I know other people don't agree with me around here.
And don't hold back, CJ. Give us your real view.
I'll never hold back. You don't need to worry about that. So I mean, the first thing is Fed interference. I don't think it's healthy the way Trump's trying to interfere with the Fed. I don't like the fact that there's these court cases around Jerome Powell and around some of the members of the Fed. Although we're talking about Rich Reeder coming in to be the next Fed chairman. He's the favourite, ex-BlackRock, as you mentioned earlier. He is down in record on many, many speeches of saying, you need to cut rates, you need to cut rates, you need to cut rates. I don't see why he's going to change at all. And so therefore, I think the Fed is a question mark.
Just to give the significance of that as well, the very first question on an interest rate decision, Federal Reserve press conference last night was, why did you go along to Lisa Cook's hearing? And he said, I think...
Who's he? Jerome Powell?
Sorry, Jerome Powell said, I think it's the most important legal decision in the history of the Federal Reserve on what happens to Lisa Cook. And so, that gives you the idea of how important this situation is with exactly what you said.
So it concerns me greatly. And I admit a lot of my concerns on a number of points are a bit out there, but hey, that's life. The second thing, you've got a huge US budget deficit, needs massive amount of external financing, and people seem to be much more reluctant than they have in previous years to finance that. China's buying a lot of gold rather than buying a lot of bonds. I easily see the Japanese thinking much the same thing, because the only way they can influence Trump, we know from what happened last year when when US bond yields went up sharply. A lot of people said it was China doing the damage. It wasn't. It was Japan. Japan stopped buying, and so Japan can influence in that way. So, all this money needs to suck into the States, and people are starting to say, you know what? I'm not so sure about the US. I don't know whether I want to do that. The US Treasury clearly, I say the US Treasury, that's wrong. Trump clearly favours a weaker dollar. Most arms of the US government are lapdogs to Trump. So whatever they say, I think they're quite happy to let that happen. And my final one is just this the unprecedented unpredictability of Trump and his new empire model. Remember, we've got 3 blocks now. We've got the Western Hemisphere, which is my block. I do what I like there. Venezuela, et cetera, et cetera, et cetera. Then he's talked about the big enemies being Europe, not China, not Russia. You guys get on with what you want to do. I'm looking after my bit. So we've now got this, we're going back in time, and John's much more history literate than I am. But you can go back to before the Second World War, before the First World War. You go back to these empires and how that all worked. Things didn't end nicely in those days when that sort of thing happened. So that's one point. The second thing, remember, Trump is a property guy. I've talked about this so many times. I'm going to go through it again. If you're a property guy, you buy an asset. You leverage it. So you've got a slither of equity, lots of debt. You then try and get lower interest rates. When the lower interest rates happen, the value of the property goes up. Your equity goes up massively. Debt stays the same. You pay the debt back. You got loads of money you've made. But when interest rates go up, your equity disappears, and you basically say, your problem to the bondholders, I'm going Chapter 11 on that property, and you move on to the next one. And Trump has done this many, 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 many times.
He's never been in control of interest rates before. They're like he wants to.
Correct. Now, if the US debt continues to rise with yields, so if US wants to borrow more, yields go up, and it starts to get difficult to pay, what odds are there on the US defaulting? What odds are there on this empire saying, do you know what?
I thought Trump was the
I
mad one.
I ain't gonna pay you. Now, do I think they're going to default? No. Could they extend maturity? So you've got a 5-year bond. They say it's now a 30-year bond. Of course they could. Why not? And for all those people who doubt what I'm saying, I mean, look at these people. They're doubting what I'm saying. And I do I believe it? No. If I did, we'd have a different views across the board. But it's unbelievable to say these things. But it's about as unbelievable as telling an ally you want to militarily attack them for their territory, which is what's happened with Greenland and what is being insulted all the time in the way he talks about Europe. So to me, this guy is completely out of control. Remember when Stuart Thompson came in and said, do not underestimate how desperate this guy is to make sure he doesn't lose the midterms, right? So I'm just saying there's lots of risk around here. And I think that means the dollar will jump. Do I think they're going to happen? No. But do I think the risks are there? Yes.
Before you guys shoot it down,
you go first.
Would you say the terms before that was impossible and the likelihood of it happening impossible? Is it impossible?
I think it is impossible. I think, look, at the end of the day, Trump wants to get the US economy going as fast as it can because he knows that's how he's going to be judged in the midterm elections. And to do that, he's already trying to get things like prices down. And he's taken the tariffs off of coffee because coffee price had gone up so much and things like that. So he's making a lot of efforts to do that. That's why he wants a interest rate friendly sort of chairman of the Federal Reserve. And Rick Reeder's not going to be a madman. He is respected by markets. He runs all of BlackRock's bonds around the world. And there is a debate about what is the neutral level where interest rates should settle, given the current beginning to decrease in inflation that's coming through the numbers. And a lot of people, the argument is whether it's another 0.25% off from where we are or it's 0.5% off. And the market is saying 0.5% off in the next 12 months gets you to what most people think is a neutral interest rate. That's not madness. That's not like saying we had to cut interest rates by 2%. And in the background, the bond market is stable. You've always said the time you get bearish for America is when the bond market goes mad. And, international holdings of US assets has remained very solid, despite what we say. Look, the US has got 4% of the world's population, 25% of the GDP, and 60% of the capital markets assets. They are massive, and you can't ignore them, and you can't run away from it. And the liquidity that a lot of countries like China, like the UK, if they want to use with their foreign currency reserves, their foreign reserves, they have to put it in big liquid markets, and the Americans have the deepest liquid markets in the world.
Let's say IG had a prediction market on the chances of it happening. What's your price?
I'm agnostic about the dollar. I think Chris makes some very good points about why sort of Europeans might want to come away from investing in the US as much as they do. Doesn't mean they're going to take all their money out. It just means they'll invest less. And that might mean the dollar goes down a bit, particularly if interest rates are still expected to come down and rates in Europe and UK, or Europe particularly, are not expected to change anymore. So the differentials start to move in favour. And that's a very sensible thing to think about. This week we've had a 2.5% fall in the dollar index. It's been a big fall, and that's helped things like gold and silver and emerging markets, because emerging markets are big beneficiaries of a weaker dollar. But I think at the same time, if he gets this economy going, growth also tends to attract foreign assets and foreign inflows. So if he gets the economy growing, it's already growing at 4.5%. If the one big beautiful bill's just about to come through, all the other stuff we talked about before, all the efficiencies from AI and the AI spending, then you could get an economy growing at 6%. And that will attract foreign money into it, because those things will want to find homes in growth areas. That's what people do.
But on the other side of it, obviously, is cost of living, right? Because it was the cost of living that did for Biden, or rather Harris. And it was the cost of living, well, a lot of things did for the Tories, but obviously the cost of living was one of them. I just think as well that whoever he appoints, their incentive set changes the minute they get appointed. So it's one thing if you're running BlackRock to want low interest rates. It's another thing when you're running the Federal Reserve to want to become known as the next Arthur Burns. Arthur Burns, of course, famously was the head of the Federal Reserve under Jimmy Carter, and he went down, perhaps slightly unfairly, in posterity as the guy who let inflation get out of control, and then Paul Volcker had to come in and clear up the mess. I'm like you, I'm agnostic about the dollar, and I agree. If the dollar were to depreciate a lot, then you would buy emerging markets. But there's one longer-term risk, which doesn't really affect your portfolio at the moment. It comes down to what you were saying earlier. And this is this emerging market type risk about blurred boundaries between the state and the private sector. Now, as we go into the midterms, you want to get the cost of living down. Trump's already taken actions which have impacted the corporate sector. And is there a risk that he will take further actions which almost amount to price controls or other controls that we saw last in the 1970s, really, in developed markets, and we've seen all the way along in emerging markets or emerging economies? So that strikes me as a bigger risk, but that's more of a direct risk for the equity market rather than the dollar.
Trump did actually intervene this week. They have in America, if you instead of NHS, you have health insurance.
Yes.
And people have to go through what's called Medicare companies.
Yeah.
And they were budgeting, Medicare companies were budgeting for price increases of between 4% and 6%. This week, on Tuesday, Trump turned around and said, I'm going to give you a 0.5% price increase.
Yeah, and the
share prices
20%.
fell 15 to 20% of all the major health companies in the UK. Now, Glaxo and AstraZeneca were not affected by that, and their shares didn't move at all. But American healthcare companies fell 15 to 20% on the back of that on one day, because he is intervening. He's price controlling, but he's doing it as a positive to try and keep inflation low, to help the people in the country, the lower end of that K that you're talking about.
There's no listening from people who don't want to hear.
And that's what Scott Bessent says. He says we want to work for Main Street, not Wall Street, right?
Yeah. So there, you just made you are making my case for me in spades, in the sense that I talk about his unprecedented unpredictability. Now, I use the example of a default. Do I think they're going to default? No, right? But is it unreasonable now? If we'd have talked a year ago and said, what are the odds that he's going to say to Greenland, I'm going to militarily attack you, we'd have said, no, not a chance. And he did it, right? So to me, the problem here isn't actually what happens so much. It's the perception of what might happen. And I think you're absolutely right. I mean, here we have a president who's behaving like somebody who is running an emerging market.
Yeah,
in the past.
With his armada of ships.
But his share prices are all rated at 20 odd times. I mean, come on, guys.
But there is still an institutional framework in the US, believe it or not. He's taken people out, for example, of the State Department at certain levels, but the core is still there. There's and he ran into huge opposition, even from the MAGA crowd, about Greenland. His perceived policy towards Russia is very unpopular. But if you look at Russia for a minute, what has he actually done? He's sanctioned Lukoil and Rosneft. And even today on the front of the FT, they pointed out that the price that Russia is getting for its oil is the lowest that it's got. In other words, by sanctioning those two companies, I think he's driven the price down that they receive to the low or mid-30s.
But that's just to force them into peace talks, isn't it?
Well, yes, of course it is. And the things he's talking about with the Ukraine aren't great. But sometimes with Trump, we overestimate the impact of what he says and his personality. And we don't look closely enough, perhaps, at what is actually happening. And I think a lot of what's happening is influenced by other people, Scott Bessent being the most obvious one, right? But also, there is this institutional framework in places like the State Department, which still has, for example, very hawkish views on China and in Russia. And in fact, the voices that were less hawkish on Russia have to an extent, been sidelined. Some of them anyway.
You mentioned Scott Bessent.
Yeah.
Isn't he the guy who said tariffs were the worst thing you could possibly have? You should never ever do tariffs because it's a ridiculous thing to do. Yeah, he's part of an operation where he says tariffs are great. You're doing a super job. The issue here that we're talking about, you're clearly not going to settle it. But the issue here is not about what the earnings the Mag 7 going to be. It's irrelevant to this debate. Yeah. This debate is: can you trust what is happening in America? Can you rely on what is happening in America? I think everything has changed. And that's why I think the dollar will come off. I'm not suggesting some of these more silly things are going to happen, but I do think the dollar is going to continue to come off, and I think it come off quite a long way.
I think you can sum this up in two words, and that's tail risk. The tail risk from the consequences of the actions of Trump have grown. And if they've grown, then that should be reflected in the multiples, and it's just not.
One last comment from me. Clearly, anybody else can go on. So let's say we're all stupid.
Yeah, fair.
That's probably a fair comment. Let's look at what markets are doing. Why is gold up so much? Why is silver up so much?
Central bank buying.
That's not going to take them up as far as they're going. What's going is a mass worry about what is going to happen. And those are normally, it could be it could all be false markets and they're going to crash back down again. That is certainly possible. But I was taught right in this early stage of my career, JP and I will disagree here because of what I'm about to say. But at the end of the day, the market is right more times than you want to admit. The market gets it first, people follow afterwards. The price action I am seeing is worrying to me.
It's the gold price going up 10% in a week isn't so much a canary in a coal mine. It's a tsunami siren, and people are still going into the water to go for a swim. They're completely ignoring the risks. Gold price is telling you something bad is about to happen.
Well, I will disagree with you, obviously. I've told you before, I think the main reason is that people like China are not putting as much into US assets and they are therefore buying other commodities. We know China already buy 55% of all the world's economy, all the world's commodities. 70% plus of iron ore, 55, 60% of copper. They are massive buyers of commodities. They're the ones pushing this market, and they've already got big reserves. They don't mind buying more because the price just keeps going up. Their reserves go up. And we talked the other day, they've got the biggest foreign currency sort of reserves now that they've ever had. And this is despite tariffs and all these efforts to try and do it. Look, I think, Michael Dell, one of the most successful entrepreneurs ever, most of you got Dell computers sitting around the place. He said, divorce
in the old days.
Yeah, well, you've got
not
Apple.
Anymore,
you've
mate.
got
Not anymore.
Apple.
Yeah.
But, he said basically, divorce your political bias from your market analysis. And I think that's what we've got to think about here. We've got to take politics out of this debate. So let's bring that back here. So let's say the dollar is going to be weak. I don't think the dollar is going to strengthen particularly, and on the margin it might decline, but I don't think it's going to collapse. Now, emerging markets do very well when the dollar weakens. And the reason for that is companies, if they ever want to issue debt in those places, in emerging markets, they normally have to do it in US dollars. And the reason they have to do it in US dollars is there's a history of devaluations in these countries, whether it be Venezuela, Argentina, Brazil, all these countries around the world have often had devaluations. So if you're going to lend money as an international investor to Argentina or Brazil, you want to get dollars. You want to do it in dollars to make sure you are paid back in dollars and not in some currency that's going to halve when they have a devaluation. So 70% or so of all the world's emerging market debt is in dollars. Now, when the dollar goes down, that means the people in those countries, their interest payments actually go down as well. And that works well because then they don't have, as a government, they don't have to use as much money paying interest on that debt. So what they do is they can use that in extra cash to invest in their economy, in their people, in getting growth back. And that's why generally emerging markets do well when the dollar falls. And it's no surprise this week the dollar's fallen 2.5%. Emerging markets have had a very good week. I think the two are very linked. And I think I'm not saying you're completely wrong, but what I would like to do, I would happily put more money in emerging markets because it's partly your view, but it's also partly my view that I think actually they're going to benefit. And I think these economies are doing well, and AI will spread out of America into other countries, and emerging markets will go for this stuff. They do already.
I think when I look at the internal drivers of emerging markets, I'm not optimistic at all. In fact, if anything, I'd be much more on the bearish side. If you're correct and on the margin you see dollar weakening and you're not concerned about the AI cycle breaking, which personally I would be, then yes, you could do particularly well buying EM. I think with China, you might have to think a bit more carefully about that, but maybe not. But my suggestion to you is that maybe you consider buying emerging market debt. So emerging market debt it's underperformed emerging market equity, but actually it's dollar-denominated debt has done perfectly well over the last year. I think it's up about 17% or so. Actually, that's local currency. Dollar emerging market debt's up about 14% over the past year. So it has been a beneficiary of what's been happening and the reallocation of money. The breakdown of emerging market debt looks far more like what you'd imagine emerging markets to be like than the equity index. So it's not full of your Koreas and your Taiwans. Instead, it's a much more diversified index. If you look at local currency, actually, the biggest constituent there is China. And given what you said earlier about the low yields, I wouldn't be so keen on local currency. So if I were you, and I don't think you'd take this, I think you'll probably continue, if anything, put more into equity. But I would consider a position in emerging market US dollar debt.
Well, this sounds like an interview for the position of chairman, I've got to say, because somebody's away on holiday next week. Where are you off to, CJ?
I'm not on holiday. I'm working. I'm in San Francisco.
He's going to help Trump. Spend the money, help the Trump.
I'm supporting the Democrats.
Do you think they're going to let you in?
Well, I'm going to have to make sure I get rid of my social media accounts.
So you are not going to be here next week. Therefore, act now or forever hold your tongue, because who knows what's going to happen in the 2-3 weeks until you're back. So what are you suggesting that the portfolio changes should be this week?
I've looked at the US, at the entire portfolio, just to sort of guess at what our US dollar exposure is. I mean, it's not as easy as it just sounds, because various indices have got more US dollar exposure, and so you can get quite complicated in it. But I reckon we've got about 47.5% exposed to US dollars. And that to me is too much. Now, copper and the World Mining Trust, which I say are exposed, are not, they're not really. It's a different story.
But they're beneficiaries of lower dollar, to be fair.
They'll be beneficiaries of dollar weakness.
Just as a reminder, commodity prices go up when the US dollar goes down.
Correct. So I think it's more like 35% is an exposure. And as I said, it's very inaccurate. Now, we're running with iShares US Treasury bonds 7 to 10 years, 15% of the portfolio, and I don't want those. I don't want that dollar risk. So I'm going to be saying that we're going to sell those. Mm-hmm. I personally don't know where to put them, so I'm going to think about putting some of that in the front end of the UK government bond market. The reason I say that is because even if we have political issues going on in the UK, I don't think it's going to affect our interest rates. We're going to keep our interest rates quite low. So as long as they're short-dated, we've talked before about how short-dated and more dominated by interest rate expectations.
So it's pseudo-cash.
So pseudo-cash. But if there does become a problem in the world, they'll do well. So that I quite like. I would like to buy some more emerging market because they've done well. They've got good momentum. I like that. So I do like the emerging markets.
That's equity, Chris, rather than debt.
Well, I'm go back to what we've said before. We don't feel any need in this podcast to think about bonds, equities in that sense. What we're talking about is what are risk assets, what aren't risk assets. EM debt to me is a risk asset. And therefore, I'd rather go for the full-throated emerging market equity than emerging market debt. But it's something we will look into because it's not something we've had before. But I would buy some emerging market. We've got 5 at the moment. I might take that up to 7.5, perhaps 10. Thinking, look at you two guys. Fresh from my victory on the DAX, I think I better close that one now before it vaults up. So I personally would also start a position in the DAX. I like the idea that that Europe's fiscally spending. I think they will. I think one of the big messages this year will be more fiscal issuance. More spending. We're going to do more in the UK. We're going to do more throughout Europe. And I quite like that, the equity market as being a beneficiary of that. So I come down to, I'm selling my 15% US Treasury bonds. I'm investing 5 into emerging market and 5 into DAX. So the question is, I've re-risked the portfolio a little bit. Do I want to sell something else to keep that risk at a level which suits things? And I think I do want to sell something else, and I would sell 5% NASDAQ out of it. Now, I admit there'll be people around here who will now start throwing things at me. So to me, it's a question of where you want that risk balance. I mean, I could be persuaded not to sell it. I don't think we've got any big problems coming at this minute, but I'm just trying to think about that.
Well, considering an hour ago you said, I think this is the top of the US stock market for a very long time, then I would have to go with you.
S&P.
Well, NASDAQ, S&P, same.
NASDAQ's different.
NASDAQ's very close to its all-time high, but it's having it's had a very good week.
Correct.
And but part of it is a very good reason for that. The earnings are coming through, and they're beating expectations.
I mean, Microsoft's down 5%.
NASDAQ is a bigger beneficiary of a weaker dollar than any other market in the US. Like 50% of the earnings in NASDAQ come from overseas.
Oh, Right.
So actually for them, remember, it's like when the pound falls and you get foreign currency earnings come in, you get an upgrade. That could hurt the FTSE 100. I would say, why don't you sell a bit of the FTSE 100?
Well,
we've got 12.5%.
I'm not anti that. I'm not anti that.
Because if you're right and you think, that sterling will strengthen against the dollar, well, that could lead to a downgrade of UK earnings and UK companies, because 70% of the UK's earnings have come from overseas, from other foreign countries.
There's a big risk difference. There's a difference. We're increasing risk by 10% here. We're buying 5% emerging markets, 5% DAX, which are both risky equity profiles. To then sell the FTSE 100, which is a low risk, against NASDAQ, which is high risk, then you're hugely jumping.
Well, I'm not sure in reality you are, because a lot of the FTSE exposure is mining.
That's very small,
right?
7%.
So if we think that some of these metals have got a bit too excitable, that may cause a struggle in FTSE.
Well, then sell the World Mining Trust then.
Well, no, because I want to have some exposure to. I want to have some. You can't just say, I believe this, so I'm going to do that. Because if you do that, you'd be in cash almost all the time. You wouldn't have had the upside that we've had so far this year. We've got to balance between what we really strongly feel is going to happen and what might happen. And all I'm saying is, at the moment, my big strong view is in the dollar, and I think the dollar is going to is going to weaken. I am trying to work out, though, how I fund about 10% of equity investment, whether I want to reduce equity investment or not. Now, I don't care whether that reduction is in FTSE or in the NASDAQ. Yes, there is a beta in those things, but they get driven. They're driven by different things. So that's what I'm trying to work out in my mind. And I can see a point, having got 12.5% in FTSE, taking FTSE down.
It's our biggest position.
Right? Because it's done very well, but just modifying things.
It's defensive. That's the core reason why we've got 12.5%, because it's a very defensive index.
But look, just if you think, international investors will start to think about, the election potentially in the elections in May. And there is typically a bit of withdrawal from foreign investors as you go into the UK elections, because they're unpredictable at the best of times. Now, everyone's saying that Starmer is under pressure, and then if he gets replaced afterwards, then people will take more money out of the UK. That slightly worries me about the gilt position, but it's short-term gilts, so I agree that it's not necessarily sort of an impact. If it's longer-dated gilts, I'd be very worried about it. But I think that there is a chance that the FTSE will suffer a bit as you get towards those elections, just because the marginal money for international investors are less likely to go. That's May.
Right.
So equity markets think 3 to 6 months ahead. We're banging and getting into that.
Not of local elections for the FTSE 100, where
I'm just saying at the margin, but that's why I prefer the DAX or something like that. DAX and emerging markets to me are better. The FTSE's done really well. It's 12.5% our position.
It's doing well.
Okay, so I'm going to call it, because that's the job of the chairman. It's never easy, but someone has to do it. So we're going to sell out our US Treasury bonds 7 to 10 years. Okay, we're turning that all 15%. We're going to put 2.5% into emerging market. We're going to put 5 into DAX, and we're going to sell 2.5 for the FTSE. And that is what we're going to do. The remainder of that Treasury 7 to 10 year stuff is going into UK 1 to 5 year, and that will hold me over my week away.
Right, the man who just told us at breakfast that he thinks the US markets are at their all-time highs and we'll never see them for long again is not selling any US exposure, and then he's off to the US.
Nothing like being a hypocrite.
That economy is going to boom while you're out there.
JP, thank you very much for joining us.
It's been a pleasure. It really has. So very stimulating. Thank you.
And absolutely fascinating. We'd love to have you back sometime.
Well, I'd love to come, so let me know.
I'm sure there are many more stories that you can give us.
Yes, there certainly are about Chris as well. So I didn't really get my Chris stories in, but maybe next time.
Perhaps next week. But I'm all right. Yeah, that sounds great.
He's reminded me of a few, so maybe.
Thank you very much for joining us. If you've got a question to ask on email, please send it in to
theartofinvesting@ig.com.
Give us a like and subscribe on the platform that you are listening or watching on, and look forward to seeing you next week.